All right, let's talk about money and the banking system here. This will be the fourth video of Unit 4. We're going to focus mainly on three things here. We're going to look at some terminology first, looking at characteristics and the functions of money. We're going to take a minute to do a brief history of money in the United States, and then we'll finish up with a brief overview of the Federal Reserve System in the United States. Let's jump in. All right. First of all, let's get some vocabulary knocked out. I think some of these terms you've probably heard before in previous social studies classes, but just looking at the evolution of money and how we've gotten to where we are today. Many early economies began on a system of barter, which is an economy that runs completely moneyless and is simply based on trade of goods and services that are deemed valuable, and traded based on trying to come up with an equal value based on the need of one person over another. So it's a barter system, been done for thousands of years and still continues on to today to some extent. Then we move to a period of commodity money where money starts to begin to exist, but we use them as an alternative. Like they have a use beyond them being money. So they have a actual intrinsic value beyond them being defined as money. So we've seen this definitely in gold and silver and other precious metals for sure, but also seen some primitive economies that are based on things like animal pelts and the fur trade. So there's a big change that's occurred from that when we move to fiat money, which is a little bit more common in the present day. This is money that does not have that commodity value, but is based on just simply a government decree. So there's no real value to it other than the fact that the government has deemed it to be of value. All right. So you think about our paper money in the United States that has no actual value other than the fact that we believe that it has the value that it does. So what does it take to be money? We look for four characteristics. It needs to be portable, so easily moved, and more importantly, easily transferred from one party to another. We need it to be reasonably durable, with limited deterioration over time so that it can be used over and over again. With our paper money, which you might say, well, our paper money is not super durable. It is also, decommissioned and then new money taken and put out into the economy occasionally. So we're removing the deteriorated money and putting in new money in place of it. Divisible, it can be broken up into smaller units to make smaller transactions happen. That's a big deal in terms of trying to, especially with something like a barter economy or even commodity economy, where you're trying to match things up as equal, and it's difficult to do if you can't divide things. And then finally, limited supply. If we all had a printer where we could print as much money as we wanted, the value of the things that we currently own would not, the money would be worthless, right? If you knew that everybody that you knew had a printer, they could print as much money as they want, how much would you sell your car for? Something that you actually have deemed to have value, knowing that you can print as much money as you want and they can print as much money as they want. You wouldn't make that deal. You would not be willing to trade your car for money. All right, functions of money. Let's look at that. Three different things here. Medium of exchange. Okay, this is typically what we consider to be the basis of money. We use it to buy stuff. It's accepted by all parties to be used in transactions for goods and services bought or sold. So medium of exchange. A measure of value is a way of we can actually compare one product to another. So it's a measuring stick to provide us with a way to say that this is worth more than this. And then finally, a store of value, where we can save our money in terms of purchasing power so we can use it as a later time. So you're going to need to know those three functions of money. Let's quickly run through some history here in the United States. I'm going to be really brief with this. So we went, Revolutionary War. Money's printed from a lot of different sources. It's kind of an unorganized time in terms of our use of money. We're trying to fight a war. We're loosely connected states. How do we deal with all of this? Most of this is going to be untrusted and or worthless because of the lack of trust there, that it actually has value. So in the early 1800s, after we are actually independent, we begin issuing money through state banks that are regulated individually by states. That creates some issues as well because, transferring money from state to state becomes a problem. And these notes, the paper money that were created are exchangeable for gold and silver at the time. Civil War, we began taking Congress, so our federal government for the first time is issuing its own paper money, not backed by gold because we needed lots of money to fund this war. So this is the first one, a legal tender by government decree, which again, that's fiat money. And then after the Civil War, we begin working towards national banks, organized through the states to charter banks within the United States and try to get us a little bit more on the same page, not using separate money from state to state. Then moving into the 1900s, we see the Federal Reserve System created, which we'll go into detail on in just a moment. In 1913, during the 1930s Great Depression, we have a few things happen with that. So banks are overextended, trying to, people have a panic, go into the bank to get their money out, and the banks do not have enough money to make all of the withdrawals that are being requested. So they close. These are known as bank runs. And then after that occurs, we do a couple things. We abandon the gold standard, first of all, 1933. We're not going to actually legally make that happen until 1971. So the gold standard being that you can exchange paper money for gold currency. So kind of backing it up. So even though it's fiat money, it had kind of that commodity-based feel to it. So now it's completely based on fiat. And we also create the FDIC, which is the Federal Deposit Insurance Corporation, which insures bank accounts to try to get people, the banks to regain some trust in individuals that your money will not be lost if it's held in our bank because the federal government is backing it up. Let's take a look at the Federal Reserve and what that's about. We need to know this because we are going to look at a concept called monetary policy here in a moment in a future video, and you need to have kind of this background in place. So this is a privately owned, government-controlled bank. This is a complicated situation because we don't see much of this we don't see this combination of private and public very often. All right, so the government controls this. They oversee the banking industry in the United States, and like I said, they manage monetary policy, which will be a future video. So member banks through the states and local areas own the Fed, the Federal Reserve, as a corporation. They own it as stock ownership. There are 7 members that act as the board of directors, and these are appointed by the president in over 14-year terms, but they do it every 2 years. So it's like on a rotating basis. Chairman is selected, and they lead that process. There's also advisory committees that are set up to advise the board, and they're made up of member bank representatives. So there's that connection there to the smaller banks, and then also the Federal Reserve in itself. And it's just kind of loose. It organizes everything together and gets everyone on the same page. And also they have this Federal Open Market Committee where the board members and then the district bank presidents set monetary policy, which again, that's going to be a later video that we're going to get into. All right, so that's going to wrap us up on money and banking. I'll see you guys next time.